Hello there, and welcome to our latest quarterly videos. Now, as usual, we're producing these videos to accompany our quarterly written report. Now, that was produced using data from 4th of April. Now, I don't know if you've noticed, but there's been quite a lot going on in the markets with Mr. Trump and his tariffs. It's moving everything and it's changing all the time. So we're going to do things a little bit differently this time around. I'm filming this on 17th of April, and so what we're going to try and do is bring things a little bit more up to date than what's in the quarterly report. Normally we do 3 videos. This time around we're only going to do 2 videos. And that's because the economic and market situation is basically being entirely dominated by what's happening with the tariffs. If we look at what's been happening so far this year, then economic growth has generally been fine. And inflation is generally reasonably under control, albeit it's slightly higher than we'd like it to be. So if we look at just current data, it all looks fine. But of course the outlook is entirely dependent on what happens with tariffs. In the report I use this chart to illustrate, which is from the OECD's quarterly outlook, which they published in March. So that was prior to the Liberation Day announcement when most of the tariffs were announced. But I still think this is a pretty good summary. So on the left we have the OECD's prediction for global economic growth, and on the right their predictions for global inflation. And on both charts the red line is their prediction from December, whereas the blue line is their latest forecast, taking into account what we knew about tariffs at the time it was published in March. We'll just ignore the green line for now. But in short, you can see that the economic growth forecast has been cut, and meanwhile they're predicting higher inflation this year than they were in December. Now, if anything, the actual announced tariffs are steeper than expected and could therefore have an even greater effect. So put simply, a tariff is essentially just a tax on imports, and that means the price of those imports or those goods is going to have to go up to cover the cost of the tax. Or alternatively, the company that's selling those goods could decide to sell them for a similar price to now, but take less of a profit. Either way, that's not very good for the economy. And I said before that everything's changed several times already in the last few weeks. For example, the initial tariffs announced on China were 34% on top of the existing 20%, so a total 54% tax on any Chinese goods going into America. So they put those tariffs out and then China retaliated. So the US took another step and put that tariff up to 125%. And then finally they introduced another 20% border tax on top, which takes the total tax on a Chinese good coming to America to 145%. Of course, this is going to have a big impact potentially on the Chinese economy, but also on the American economy and on American companies. For example, Apple's iPhone is largely made in China. About 80% of the iPhones that are sold in America come from China. The other 20% are assembled in India, but even there, a lot of the components are made in China. Now, according to UBS, an iPhone 16 Pro Max, which currently costs about $1,200, would potentially go up to about $2,150 at that high tariff level. But then, over the weekend, the US has now announced that certain electronics will be excluded from the tariffs, or at least will be for the next 90 days or so. And that includes things like the iPhones. And then it became clear that actually, even though that exclusion is only temporary, in the meantime, that 20% would still apply. So it's all still up in the air. So what that means is the iPhone, for an American trying to buy it, is going to be more expensive than it was before. I don't know exactly where that will be. It will be $1,300 or $1,400 instead of $1,200. Now that's not as bad as it could have been, but it's still very inflationary. And you would imagine that at that price point, Apple are likely to sell fewer iPhones. So that's not good for the consumer. It's not good for Apple as for their profits and therefore their share price. And it's not good for the American economy as well as the Chinese economy. The other point is we still really don't know where things are going to end up. And all of this uncertainty causes business and consumers to act differently and put off that new investment or that new purchase until they feel more confident. Now, all of this has unsurprisingly hit the stock market, and it's actually hit the US stock market harder than most. This chart shows the S&P 500, the main US market, so far this year for a sterling-based investor, a UK-based investor like we are. And this is up to 15th of April. Now, as of this point, it's down about 13% from 1st of January, despite the recent rebound. And at one point, actually, it was more than 20% down from its recent peak. However, it's worth pointing out that non-US stocks haven't done quite as badly. If we add to the chart the MSCI World ex-USA index, this is basically an index of the largest companies in the world outside of the USA, we can see that things have actually not been quite as bad. And this index is actually flat so far for this year. And as we've covered in recent editions of The Pulse, this is largely due to some of the other things that Trump has been doing, in particular in relation to his attitude towards the war in Ukraine and towards Russia. And put in short, lots of people in Europe feel they can no longer rely on the US for their security anymore. As a result, the Europeans may be about to spend big on defence and infrastructure. And this would help the European economy and perhaps their stock market, which is a big reason why some of those European stocks are doing better, and that's helped that index we were looking at before. The other thing that's exacerbating this trend is what's happening in the currency markets. Now, unusually for a period of economic uncertainty, the dollar has been weakening recently, as we can see in this chart. So far this year, the dollar in red is down about 5.25% against the pound. Interestingly though, at the same time, the euro in blue is up by about 3.1%. And what that means for us as investors, apart from anything, is that the losses on the US stocks have essentially been increased because the dollar has gone down as well. But the strong euro will have cushioned some of the losses on European stocks. And that has really helped that index of non-US equities we showed you a moment ago. So we've seen falls in the stock market and we've seen falls in the US dollar. But what about the bond market? Because normally when you get a period of economic uncertainty, often bonds do quite well. Because essentially what tends to happen is central banks often cut interest rates, and that makes bonds look attractive. The interest that they pay looks more attractive relative to cash, and lending money to a government such as the US or the UK is usually seen as a low risk thing to do. So when people are worried, they tend to buy bonds. However, because inflation is likely to go up too because of the tariffs, there's considerable uncertainty about whether we actually will get rate cuts this time, particularly in the US. So will the Fed take the view that the price increases are a one-off and cut anyway if we start to see a downturn in the economy? Or will they decide to keep rates high because they're more worried about inflation? We don't know the answer. And this uncertainty has led to a lot of volatility in government bonds, as you can see on this chart. So UK gilts are shown in blue and US government bonds are shown in red. And you can see that at the start of April, both of these did jump as stocks fell and investors fled for the safety of bonds. But then they started to fall again as investors started to worry about whether rate cuts would actually come through. And in the case of US bonds, you can see they're actually now sitting at quite a loss, exacerbated again by those currency movements. And in fact, many US bonds are actually held by overseas investors, including big amounts by the Chinese and the Japanese. And given trade tensions, there is some evidence that some of this money might be being withdrawn, which has exacerbated the fall in the price of the US bonds and the fall in the dollar. So where does this all leave us? Well, unfortunately, it's very, very difficult to say. The markets, the economy, it's all being moved by the whims of one person. You know, what Donald Trump does from one day to the next, unfortunately, is extremely unpredictable. So predicting where markets are going to go from here is an absolutely impossible task. But having said that, there are still plenty of things that we can do to protect portfolios from further losses and to try and take advantage of the lows and try and increase the long-term return by buying at those relatively low levels. And in the next video, we'll explain some of the things we've been doing in the portfolios and how those portfolios have performed.